Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Tony, my man, it's so good to be with you.
Good morning, Bill.
I'm going to give you a chance in a minute to introduce yourself to the audience and tell people who you are. So I think everyone's always does a better job of that. And the reason why we're sitting down here today on the Debt Doctor to talk about real estate in the world is that as young and beautiful as you look, I happen to know you've got a few years under your belt, and especially in this industry, and you've been through market cycles. And we are certainly trying to point the finger at, I like to say the broken clock is always right twice a day, but,
Yeah, absolutely.
there is no doubt that there is a sea change coming in financial markets and just in the world, whatever it is, whether you call it cyclical, brought upon by COVID, brought upon by years of free money, but there's no doubt that something's adrift. And so here we are, trying to figure out what's the cause, what does history repeat itself, where are we in the debt and real estate cycles, and I think, no better person than you who to talk about it. So Tony, before I go any further, say hello and introduce yourself.
Well, hey, thanks, Bill, for the introduction. And you flatter me with all that young talk. I appreciate it, sir. Um, it's been a pleasure to meet you the last couple of years at these conferences we attend and whatnot, and just see your charisma. And I've been following your show ever since. I'm Tony Alahverdi. I'm a local guy, just here in Central California. I've been born and raised here. I got a lot of background experience. I started when I was 20 years old. I walked into an office, with Prudential California Realty at the time. Average agent realtor was about 50 plus years, maybe minus. I don't want to.
They felt much older when you were 20, and looking up to them.
Exactly. And when you're the only young guy in the room, it's a little intimidating. So anyhow, I got my start there. I met some great people, had some great mentors. I was blessed to do that. My now father-in-law pushed me on to a great trainer by the name of Glenn Race at the time, and he was a local guy, but he has a big impact, and everybody knew him, loved him. He taught me a lot. And yeah, I was just pounding the pavement back then. My experience was from door knocking. There wasn't a big internet presence then. I think I was looking at for sale by owners in the newspaper, knocking on the doors, doing the whole
Right.
Tony, and I don't know what the heck I'm doing. And funny story, if I could get into that. My first
Yeah.
deal, and I tell people this till this day, and it's not going to be inappropriate, but it's funny. I was doing disclosures on a first deal I sold, and I was real nervous, didn't know what to do, and I was going over the organisms, my living organisms part, and I accidentally told a lady these are live orgasms. But they knew. My daughter laughed it off, and they said, "Hey, we know you're new," and it was just funny. So anyhow, I don't know why that struck me right now, but
Oh, that's funny.
no, I've been doing this for about 25 years now. Matured, after many years of the first REO market. I don't know if you were in the business. I'm sure you were in 08, 09. I was around for that.
Mm-hmm.
I was like a chicken with my head cut off, running around chasing buyers, REOs, and we
Mm-hmm.
were doing 60, 90 deals a year, maybe 100. But you got to remember the price points were real low, Bill. So
Mm-hmm.
we were were doing a lot of volume and we learned so much. We picked up so much information at the time, made some great contacts with asset management companies at the time. And that's how I got into REO a little bit. But I was also doing short sales. I don't know if you're familiar with short sales.
Mm-hmm.
And those were a real pain in the butt. Hey, my team wanted to do them. We picked up a bunch, and to us, they were slam dunks. Just took 6 months sometimes.
Yeah, no, and it's interesting that you say, like, I don't know if you know, because I obviously, to me, it's like the short sale was kind of one of my first understandings of the ability of lenders or willingness of lenders to negotiate the terms of a loan. And and it's interesting, you don't hear the term short sale a lot right now, but in 2008, in 2009 and 2000, even in 2007, before the crisis really hit, as the markets really stalled in '07, and you already had people that knew they were upside down. And what the short sale is, it's a good, might as well take a moment and kind of and add this to the educational block of the debt doctor. The short sale, because I haven't yet done an episode about it, but the short sale is the idea that if you have two disinterested parties, that if the market itself said to the lender, hey, and the seller, your property will only find a buyer that is less than the payoff of the mortgage, you take that proof back to your lender, you show them you marketed it, you follow these certain criteria, and the banks would be willing to agree to a short payoff. This probably is new to the world of the 20 something, or the
Absolutely.
30 something,
None of the new agents know about short sales. I'll tell you that.
Yeah, I didn't even think, it's so funny, Tony. I didn't even think that that would be something to talk about. But when you say it, it's true.
Yeah,
There's a whole generation that
yeah,
hasn't really dealt with it,
yeah.
because for the last 10 years, they pretty much were gone. The market was back in an equity position by the early teens.
Correct, correct. No, it was, for the bank, it was a situation where they got to avoid foreclosure. They didn't have to take possession of the property. They didn't have to cash for keys. They didn't have to deal with the hoarders or, kicking people out. And they were just hedging their bet and selling it for a short now. That's why it's called short sale, short from what they're owed. And on the borrower side, the motivation was, hey, you don't get a foreclosure on your record. Yeah, your credit gets hit with all the late payments, but then it shows it's settled. So now you don't have to wait 7 years or whatever it was to get your credit back on track. So there was a lot of motivations. We used to educate the buyers and sellers about it. And there was one bank in particular, then we'll move on from this topic. It was Wells Fargo, then Wachovia. We had a great contact with the guy here locally, and he used to get us short sale approvals in 10 days. So guess what I did? I started marching down and looking for all those Wachovia, Wells Fargo's loans, and it was better than an REO because we used to get the paperwork to them. In 10 days, we had approval. We were closed 30 days later.
Wow.
Such a quick deal. But anyhow, that was just a.
No, but let's take a moment. I don't want to ever step over anything that you say, because in many ways we are reminiscing on times that, to many of our listeners who are like you and I, experienced professionals, this is a reminiscence of 10, 15 years ago or more. To the young generation, the TikTok generation of real estate investors and brokers, this may be new territory. So it's good to know about it, because it's coming again. Now you have, certainly on the residential front, the argument can be made and has been made by, you know, the macroeconomic folks at MBA and all over, that residential real estate has the most equity it's ever had in general. When you lump all of that together, that is very, very true, but it's also you're mixing apples with oranges, because you're including stuff that's fully paid off, and you're not addressing, inside of this massive multi-trillion dollar $30 trillion residential real estate market, there's still 11 trillion, $12 trillion of debt. And that debt may only be up against 20 million trillion of that market. And, when you really nail down to it, the market is so massive. You get into like FHA loans, stuff that was originated in the last couple years. There's billions, at least, or hundreds of millions of that was originated just in the last few years. Those are now hitting double digit delinquencies. So, you are seeing some underwaterness occurring in this market already, right? I mean, I've been told by somebody that he's doing FHA short sales now. It is interesting. Let's dive into the obviously if you're brokering a short sale, you abide and you've got a client that is trying to pursue a short sale either as the buyer or the seller. You can't be involved as the investor. So there has to be a third party. That's how all these short sales get approved. It's got to be an arm's length transaction. But let's look at it from the perspective of the investor because you do, correct me if I'm wrong, that you have built up a little bit of a portfolio for yourself over the years. And so you have the experience of acting as an investor. You can go out and pursue short sales as a buyer, not a broker, that are represented by other people. So that's something that you have looked at. And it's interesting to hear that the short sales are going on. I've heard that from other people around the country as well, that these short sales are happening again. Where I do see them happening even more explicitly already is in the area of commercial real estate.
Wow. Okay. Yeah, and that's your kind of forte, and that's where, you could come in and dive in on that. I haven't seen that on that end, but I do hear a lot of defaults in the office spaces and different things like
Yeah, office space, stuff like that, So, listen, anytime, let's talk about cycles.
that. Yeah.
Anytime a market gets overheated, there's always going to be some portion of it that highly levers at the wrong valuation. Are you seeing any of that in any of your markets now?
Multifamily, here is a little delay. I'm seeing the cap rates are still pretty low because it's California, right? But investors are pushing back with the rates and everything the way it is, and they're not getting those top market pricing anymore, as they would like because of the interest rates, right? Is the main thing. So that's California market. It's a little saturated and everything else, but where I'm seeing stuff is at the trustee cell level because I did dabble in that many years ago, and that's where I picked up a lot of my investments because that's where your true investors are before before it comes on to the open market and you take on the responsibility because it's like you're buying it without title insurance,
Right.
equity, and you're doing the whole due diligence. If the house is burned down when you buy it, that's your house, right? There's no, I want to cancel the escrow. But I'm seeing a pushback. There's not as many investors. Some of the big hedge funds out there, I was bidding against because I'm just a small guy, a couple partners, and we're bidding, and I'm noticing they're stopping a lot sooner in certain areas because they're building up equity. They're seeing a turn in the market where in the past they were buying at high, margins just to get the properties, and they were holding them or flipping them. But I see that they see that there's a slowdown in the market on a whole in this area with the rates still pushing back, and these big hedge funds are slowing down and buying at a lot lower margin. I would say,
Yeah.
they want a higher margin. Sorry.
Higher margin, lower quantity that they're putting to. No, let's talk about that. I think that's a good area to kind of go down history lane again, because again, as
Yeah,
someone who's been
I'm an
around
old
for,
guy. I got a lot of
yeah,
history. So yeah.
2 decades of this shit, you've got some experience. Let's talk about that. There, because you and I both experienced post 2008, 2009. A number of private equity firms popped up and started buying these single family rentals. They securitized portfolios. They got low interest rate loans. The original founders of these organizations, Invitation Homes, American Homes for Rent, just to name a few, became billionaires.
Right. Yeah,
Um,
overnight.
yeah, and it had an interesting effect because it also made these private equity funds that you're referring to, who you're saying are now slowing down, but it made them competitors in the buying market of single family with average individuals and mom and pop investors. So both folks like you, who might have been at the courthouse steps buying stuff from trustee sales.
Yeah, and that's where you
um,
want to get them at. And for a while, there was a big opportunity there because, there was 40, 50 properties in the morning, and then by the time you get there, there's 20. So you got to do a lot of legwork because you don't know which 20 are coming up. And out of those 20, 10 would get postponed, and then 10 would go to sell, and maybe five would sell, five would go back to the REO, to the banks. So that's also a good place. We used to track see which banks took it over, which asset management companies from the recorded deeds, and we used to track those and go, try to find those guys and try to get the listing. But our ultimate goal is to buy the investment. So sorry to cut you off, but you were going somewhere with this.
no, that's I mean that's good. And then um, you saw these guys kind of buying, right?
Yeah,
And even into COVID, I would say they were pretty active. And now you're saying those guys are slowing down. I'm just trying to think it out with you. I'm
well,
trying to like,
all the, they were going off market too a lot, and I noticed that too. But the moratoriums kicked in, and they're still kind of barely withering away here in California. So a lot of stuff, it's slim pickings for sure at the trustee. So that's not you're not making a decent living over there anymore. But that was their huge avenue back in the day because there was, like I said, 10 properties going a day, five selling a day, or
right.
but I see the trends changing there is what I'm saying.
If
They're watching the prices. They're coming down.
So obviously you feel like the market's kind of inflated, but there's still you can still find opportunity. If you are an investor, which you are you buying? Are you looking to buy more now? Are you looking to sell? What's your advice and where to
You
look?
know, that's a good question, Bill. I talk to a lot of investors. A lot of these guys I've known for years, some friends, some colleagues. About 6 months ago, a lot of them tried to sell off a lot of stuff, and they got a little nervous with the market. I've held tight. I'm looking for opportunities always. Now, in our flip portfolio, we always look into buy and sell. But I'm
Right.
noticing when we're buying those, we got to get them at better margins now because what's happening is the resale 6 months from now, the appraisal, the comps are different. The comps are
Hmm.
there, but I can't sell it at that price right now. And the buyers are pushing back. They want, crazy closing costs. They want incentives to get in. And I'm talking,
The buyer's market now,
it's becoming a buyer's
even
market.
in California.
In this market's where I'm working. Yeah, it's affordability's tough. We're an hour and a half from the Bay Area here in the Central Valley, so we got a strong market there, but that's its own micro economy, there. But here I'm noticing the trends are pushing down, and the prices are pushing down slowly, and the buyers are getting better deals if they're waiting, being patient. But as an investor, either you're gonna unload your
Now you
stuff,
got to model for that loss of
yeah.
revenue down the line. So that
Right?
means you got to pay less for it now.
Correct. And the main source now is just direct to sell, off market to sellers. We do mailers, we do PPCs. We're just starting all that again, and we're getting traction. And some of these buyers, they want out for different reasons, and we're getting good deals on them because they need a lot of work. Roofs are falling apart. People have issues, life issues. So that's where we're focusing now, Bill. And I want to grow my portfolio there, but I'm also looking at 1031 and get into some business with you to maybe do some multifamily, different stuff out of state.
Well,
Anything.
the buy and hold stuff, it really just comes down to cash flow, right? And like, at the end of the day, if you have stuff that is got either a fixed mortgage or no mortgage, and it's throwing off X amount of dollars per year, on top of that, and you've got, my next go around is buy and never sell. So just start to accumulate deals that in any scenario will cash flow and make sense you know. And that's the return to reality. I think that the market, you can't buy on appreciation. You can't buy um, on a hope that a demographic is changing. You just got to go with what's so. And, now you do need to take demographics into consideration, in my opinion, if you're going to hold long term, right? Because, you don't want to buy in some, boom town that's out in the middle of nowhere with with no facilities or anything like that, just because it's cash flowing now because they, found an oil field there that's gonna, or something like that.
Yeah.
You got to take into consideration demographics long term, which is why I think California, you probably can't go wrong where you are. There's always a demand. There's always people that want to live there.
Yeah, it's affordability where I'm at because we got the Bay Area hour and a half away. We got the oceans, an hour and a half away. We got Yosemite foothills an hour and a half away. You got the lakes around here. It's a great place to raise a family. It's a conservative town. This area, it's not so gung ho with everything that's been going on that you see in the news, right? But it comes down to affordability. The interest rates have been crazy, so hopefully our administration could get those down now and get things back to normal because I'm seeing a major change slowly here.
What is I mean, what if you had to predict the future? I mean, like, pull out your crystal ball. Anything major you see on the horizon? Anything you think needs to, like, that you're on the lookout? Any concerns you have, either in real estate or debt or finance or I don't know. What do you? What's on your
Well,
mind?
I think with real estate, it's traditionally a long term game. Right? People were so used to the quick dollar. So I think if you could buy and hold and it cash flows like you said, Bill, it's never a bad idea. As far as changes coming, yeah, I mean I see appraisal prices not matching market pricing now. So that's my local market here, and that's Bay Area is a little
Right.
different, but I see that change. So I'm buying a lot more conservative. I'm seeing the phones ring more that are people wanting to sell off market. So that tells me something's going on. Um, there's a certain situation going on in the neighborhood here up in off Highway 5 that they're getting water issues. That's up in the hills. It was a great community. They had a golf course at once. Well, they have water issues now. Their utility bill wasn't paid by the west side, whatever it was, in the irrigation district, and it went up from your traditional 100, $150 a month to 650 temporarily a month.
Wow.
Yeah, so people are freaking out in there. They don't know how long it's going to last. State, federal hasn't came in yet because they said it's not emergency. You guys will figure it out with the pipelines. The sellers are panicking, and if you look there, there's 42. There's like maybe 600 homes in this community, I think it is, if I'm not mistaken. And there's all of a sudden, I think 82 homes on the market. Just like it's a crazy amount. So I've got 3 or 4 calls from sellers there that wanting to sell. So I'm looking at my comps, but I'm like, this is not correct because I got to buy it way discounted here to hedge for this issue. So anyway, there's a
No,
bunch
I agree, and I'm seeing that everywhere I look. And we're having to be more conservative. We've actually built in some negative price appreciation into our modeling as of this year. For the first time, while the rest of the time we were kind of leveled off probably too soon in our modeling, but I let deals escape us. It's fine. But we are definitely in a position of seeing that it's a buyer's market, and in a buyer's market, when time is important as a seller as it is for us in the flip market, then you need to buy more time with better pricing on the on the front end.
Yeah, so going to that, I don't think it's ever a bad time to be in real estate. You just have to educate yourself, be ready for any negative appreciation, and if it goes the other way, great, you're winning. But I always just educate my sellers and clients when I come in and say, hey, this is what's going on. If you'd like to go on open market, you can, but these are the average days on market. Otherwise, you could sell to us in our fund and you'll be out here in 10 days.
One more question. Guiding principle. You're a father. You're right. As I
Yes, sir.
recall. Yes.
Two
You're
children keep
a.
me very busy, 12 and 13, yes.
That's right. So you're probably. I don't know if you coach them or just cheer them from the sidelines or whatever it might be. You probably are right in the heart. I mean, they're just becoming teenagers. Oh my gosh, Tony, we're gonna have to drink more at the next event. No wonder we have such a good time when you're out. You and I are on traveling out of town.
Wasn't that
Yes,
was great?
I
Yeah.
see the gray as well.
Yeah,
Yeah,
the
I'm
Grays are
losing it.
there. No, I got a
Um,
13-year-old, yeah, that I've trained very well. But go ahead, sorry.
yeah. Well, what's the guiding principle that you're telling your kids these days?
Well, it's
What?
funny. Yeah, I'm
Go.
glad you asked. I mean, I'm always hard on them. Yeah, they're both in sports full time and multiple sports. So I could go on days for that, but we're taxi drivers, being me and the wife, we
Oh
go
yeah,
everywhere,
chauffeurs.
divide and conquer. But they're always, doing good in that. They love that. But I always teach them real estate is the common man's way to wealth. And they don't really quite understand that yet. But they see what I do. I take them to the houses. I kind of try to teach them stuff, give them the drill gun sometimes, watch them, help my son help me demo a roof once, just stuff like that. But I have him reading, books, well, on audio now, like Rich Dad Poor Dad, and just those building concepts. Because I say school's great, education's great, you got to have it, but if you want to, move along quick and do the common man thing and get rich, you're going to have to be in real estate. If you want to be a doctor, lawyer, attorney, that's great, all for you. But if you want to do real estate, this is what dad does, and I try to teach them the principles of that. They don't
That's
always,
really great.
they don't always
Well,
agree.
I will say, Tony, that you are much more than a common man to me.
Oh, thank you, sir.
Uh,
We've got to
and
know each other a little bit, haven't we?
yeah, no, absolutely. And I appreciate your time today. People will be able to reach out to you. Yeah, what areas of California are you in to help people?
So Central California, Sacramento is the hub, and I go down to Fresno. I've done some stuff in Bakersfield even. And I was in San Diego too pre-COVID, but I'm not there as much anymore, but I do have a lot of contacts there. That's my retirement ground, Laguna, Ocean, Orange County, and San Diego. So I go out there and keep
Oh
busy
yeah.
because that's where I want to be. So, but yeah, anywhere in California, guys, you got questions? I'm at Broker Tone on IG or LinkedIn. You could just look me up under Tony Alahverdi, and I'd love to answer any questions and collaborate with people. I'm always open to masterminds and growing and meeting people like you, Bill. You were great. I've linked with you the last 2 years at the Dallas 5 Star. And not only do we have a great time, we learn stuff, we meet a lot of interesting people. And that's the next part of my career, put myself in the room of smarter individuals because, I'm just a common man, as you know.
And the common man with stories to share, and
Yeah,
that's what
amen.
happens now. Is that it's our time to give back, not just to our own kids and our own families, but to the world of real estate and the world of humans that are out there trying to make a living for themselves,
Amen.
or
I want
make
to
something.
just share something you gave me when I first met you, and I'm still going through it, so don't hate me. But you remember this?
Yeah, there we go.
And
Win-win.
the win-win
That's
revolution. He even signed it for me. There it
that's
is.
right. That's right.
So I'm gonna hold on to this because you're gonna be a rich and powerful man one day, and I want to just say I know it's Bill.
Tony, it's been great. Thanks for hanging, bro.
I really appreciate you. Let's get on a call again and see how we could
Yeah.
collab together, sir.
Something for the legacy books. Have a good one, pal. We'll see you.
Hey guys, God bless.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.